Top beginner investments for 2025. Start simple. What's up everyone? It's Sebastian, and welcome back to the channel. Listen, I get it. The world of investing can seem like this big, scary monster, especially if you're just starting out. You might be thinking, where do I even begin? Is it too late to get started? But trust me, it's never too late. Today, we're breaking down the absolute best investments for beginners in 2025. And the best part? You don't need a ton of money or a fancy finance degree to get started. Remember, starting simple is key. Fancy doesn't mean better. Alright, let's kick things off with index funds. If you're new to investing, you might feel overwhelmed by the sheer number of options available. Stocks, bonds, mutual funds, ETFs, the list goes on. But don't worry, index funds are here to simplify things for you. Think of index funds like the ultimate all-in-one investment package. They offer a way to invest in a broad range of assets without having to pick individual stocks or bonds. This makes them incredibly convenient and accessible for everyone, from beginners to seasoned investors. They're like a basket of stocks that track a specific market index, like the S&P 500. When you invest in an index fund, you're essentially buying a small piece of every company in that index. This means you get to own a slice of the entire market, rather than betting on a single company. Now, why are these so great for beginners? Two words: diversification and low fees. Diversification is a key principle in investing. It means spreading your investments across various assets to reduce risk. With index funds, you achieve instant diversification because you're investing in a wide array of companies. Diversification means you're not putting all your eggs in one basket. Imagine if you invested all your money in a single company and that company went bankrupt. You'd lose everything. But with index funds, your investment is spread out so the poor performance of one company won't drastically affect your overall portfolio. Instead, you're spreading your money across hundreds, even thousands of different companies. This includes companies from various sectors like technology, healthcare, finance, and more. This broad exposure helps to balance out the ups and downs of individual stocks. This helps to reduce your risk because if one company doesn't do well, it won't tank your entire portfolio. The gains from other companies can offset the losses, providing a more stable and predictable return on your investment over time. And low fees? Well, that's just more money in your pocket. Fees can eat into your returns over time, so it's crucial to keep them as low as possible. Index funds are known for their low expense ratios, which means you get to keep more of your hard-earned money. Index funds typically have much lower fees than actively managed funds, which means more of your money is working for you over the long term. Actively managed funds often charge higher fees because they require a team of analysts and managers to pick stocks. In contrast, index funds simply track a market index, which is a more cost-effective approach. Two of the most popular index funds out there are VTI, which tracks the entire US stock market, and SPY, which specifically tracks the S&P 500. VTI gives you exposure to a wide range of companies across different sectors, while SPY focuses on the largest and most established companies in the US. These are both fantastic options for beginners because they're simple, straightforward, and offer broad market exposure. By investing in VTI or SPY, you're setting yourself up for long-term growth with minimal effort. So, if you're looking to start your investment journey, index funds could be your secret weapon to success. Now let's talk about fractional shares. Ever wanted to invest in a company like Amazon or Tesla, but thought, there's no way I can afford a whole share of that? Well, that's where fractional shares come in. Fractional shares allow you to buy a portion of a share instead of the whole thing. So, let's say Amazon stock is trading at $3,000 a share, and you only have $300 to invest. With fractional shares, you can buy 1/10 of a share of Amazon for that $300. This is a game changer for beginners because it makes investing in expensive companies much more accessible. Plus, it's a great way to diversify your portfolio even further without breaking the bank. Chapter 3. REITs, your gateway to real estate. Welcome to the exciting world of real estate investment trusts, or REITs for short. In this chapter, we're going to explore how REITs can be your gateway to the lucrative world of real estate without the usual hassles. Next up, we have REITs, or real estate investment trusts. These are special companies that allow you to invest in large-scale, income-producing real estate. Think of them as a way to pool your money with other investors to own a share of properties that you might not be able to afford on your own. Now, I know what you're thinking. Real estate, that's not exactly beginner-friendly, is it? The idea of buying properties, dealing with tenants, and managing maintenance can be overwhelming, especially if you're new to investing. And you're right, traditionally, investing in real estate has meant buying properties, dealing with tenants, and all that jazz. It involves a lot of time, effort, and expertise. Not to mention the significant amount of capital required to get started. But REITs offer a much simpler way to get in on the action. With REITs, you can invest in real estate without having to buy, manage, or finance properties yourself. It's like having a professional real estate manager working for you, handling all the complexities while you sit back and enjoy the potential returns. REITs are companies that own and operate income-producing real estate, like shopping malls, apartment buildings, or office spaces. These properties generate rental income, which is then distributed to REIT investors in the form of dividends. When you invest in a REIT, you're essentially buying a piece of all those properties. This means you get to enjoy the benefits of owning real estate, such as rental income and property appreciation, without the headaches of being a landlord. This means you can benefit from the potential for rental income and property appreciation without the headaches of being a landlord. Plus, REITs are required by law to distribute at least 90% of their taxable income to shareholders, which can result in attractive dividend yields. Plus, REITs are traded on stock exchanges, just like regular stocks, making them super easy to buy and sell. This liquidity is a significant advantage as it allows you to enter and exit your investment with ease. So whether you're looking for a steady income stream or long-term growth, REITs can be a valuable addition to your investment portfolio. Chapter 4. High-yield savings accounts. Don't forget about savings. Finally, let's not forget about the power of good old-fashioned savings. Savings might seem like a boring topic compared to the excitement of investing in stocks or cryptocurrencies, but it plays a fundamental role in financial stability. It's the bedrock upon which you can build your financial future. Now I know what you're thinking. Savings? That's not really investing, is it? And you're right, it's not the same as investing in the stock market or buying real estate, but hear me out. Savings, especially in high-yield accounts, can be a powerful tool in your financial arsenal. And you're right, it's not the same as investing in the stock market, but hear me out. High-yield savings accounts offer a unique blend of safety and growth. Unlike the stock market, where your investments can fluctuate wildly, a high-yield savings account provides a stable and predictable return. High-yield savings accounts offer much higher interest rates than traditional savings accounts, which means your money is actually growing at a decent rate. These accounts are typically offered by online banks, which have lower overhead costs and can pass those savings on to you in the form of higher interest rates. While it might not be as exciting as picking stocks, it's a crucial part of any solid financial plan. Think of it as the foundation of your financial house. Without a strong foundation, the rest of your financial structure is at risk. High-yield savings accounts provide that stability. Think of it this way: your high-yield savings account is your safety net. It's the money you can rely on in case of emergencies, unexpected expenses, or sudden opportunities. Having this safety net allows you to take more calculated risks with your other investments, knowing that you have a financial cushion to fall back on. It's where you keep your emergency fund, your down payment savings, or any other short-term savings goals. These are funds you might need to access quickly, and a high-yield savings account provides that liquidity while still earning you interest, or any other short-term savings goals. Whether you're saving for a vacation, a new car, or a home renovation, a high-yield savings account can help you reach those goals faster thanks to the higher interest rates. And with interest rates on the rise, it's a great way to earn some passive income on your money while you're figuring out your next investment move. So, don't overlook the humble savings account. It might not be glamorous, but it's an essential part of a balanced financial strategy. By incorporating high-yield savings into your financial plan, you're setting yourself up for long-term success and stability. So there you have it, guys. 4 fantastic investment options for beginners in 2025. Remember, the most important thing is to just get started. Even if you can only invest a small amount each month, the power of compound interest will work its magic over time. Thanks for watching. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell for more investment tips. Remember, starting simple is the best way to begin your investment journey.